Welcome to the Deep Dive. Today we're digging into something pretty fundamental in business investment. How easy is it really for companies to shrink?
Right. It's this idea of irreversibility.
Exactly. Like think about an airline. Buying new planes? Okay, that's one thing. But selling them off. Or closing a terminal? That seems much, much harder. More costly anyway.
And that potential cost, that difficulty in reversing course, should theoretically make firms more cautious about expanding in the first place, shouldn't it?
You'd think so. But then this study came along by Clementi and Palazzo, let's call them CP, that really stirred the pot.
Ah, yes, the no sign of irreversibility paper.
That's the one. They looked at public companies and found something quite striking. Over 18% of them, in any given quarter, seem to have negative investment rates.
Which CP took as evidence that, hey, these big firms actually can downsize pretty easily. They sell off assets, no big deal.
Yeah, and that conclusion was, well, it was pretty different from earlier research, right? Like Cooper and Haltiwanger.
Absolutely. Their work on manufacturing plants showed a very different picture, much less negative investment, more asymmetry. CP essentially argued that public firms were just a different beast altogether.
Okay, so that sets the stage. CP says no irreversibility, based on this 18% negative investment figure. But now there's new research, a study by Bai and colleagues that takes a second look.
A much closer look, actually.
And that's our mission today. Unpack this new study, see what issues it raises with CP's work, and figure out if that no irreversibility claim actually holds water.
Spoiler alert, buy it all. Argue it really doesn't. They find some significant problems in the original analysis.
So this new paper is doing what's called reproduction and replication.
Exactly. Reproduction is trying to get the exact same results using the original author's methods and data. Replication is seeing if the core finding survives when you, say, fix potential errors or tweak the methodology slightly. Buy it all. Did both.
And they found issues. Okay, let's start with CP's original study. What exactly did they do to get that symmetric-looking distribution with so many negative rates?
Well, they took Compustat data, quarterly data, for U.S. public firms from 1978 to 2016. They calculated gross investment rates for each firm quarter.
And the key finding was that distribution, the shape of it.
Yes. They found it looked pretty symmetric with this 18.2% chunk of negative rates. And that symmetry, or lack of strong asymmetry, was their basis for saying irreversibility wasn't a major factor for these firms, unlike those manufacturing plants studied before.
Okay, got it. So now, enter Bai et al. Where did they find the cracks in this? What was the first big issue?
The first one, and it's a really big one, has to do with how CP calculated gross investment itself, specifically how they handled depreciation.
Depreciation, okay. How does that work?
So CP said they calculated gross investment by starting with the growth in net property, plant, and equipment, net PPE, and then adding back depreciation, which sounds right in principle. But the kind of depreciation rate they added back was the problem. Net PPE, by definition, already has the company's accounting depreciation taken out. To get back to gross investment, you need to add back that same accounting depreciation.
Okay, makes sense. What did CP do instead?
They added back geometric depreciation rates from the Bureau of Economic Analysis, the BEA.
Uh-oh. Why is that wrong? Are they very different?
They can be, yes. BEA rates are generally smoother, industry-level estimates. Crucially, they tend to be lower than the actual accounting depreciation rates firms use on their books.
Ah, I think I see where this is going. If you add back a depreciation number that's too small.
Exactly. You underestimate the true level of gross investment. The whole distribution gets artificially shifted to the left.
Making it look like there's less positive investment and more negative investment than there really is.
Precisely. And Bai et al. Showed this wasn't a minor effect. When they corrected just this one error using accounting depreciation instead of BEA rates, that negative investment fraction plummeted.
How much did it drop?
In one of their main analyses, it went from CP's 18.2% all the way down to about 6.1%.
Wow, okay, that alone is huge. That fundamentally changes the picture.
It really does. And there's another wrinkle. BEA rates are industry-specific, while accounting rates are firm-specific. Using BEA rates also kind of smoothed over differences between firms.
So it hid some of the variation, too. Okay, that's issue number one, the depreciation calculation. What else did Bai et al. Pinpoint?
The second major area was CP's use of what Bai et al. Called non-standard sample screens. Basically, unusual ways of filtering the data.
Filtering, like excluding certain companies or time periods.
Exactly. First, CP dropped the first 12 quarters, that's 3 years of data for every firm.
3 years? Why would they do that?
It's not entirely clear, it's not standard practice, buy it all. Call it an age screen, and when they removed it, guess what happened?
Let me guess. The distribution shifted, right? More positive investment showed up.
You got it. The distribution became more right-skewed. Which makes sense, right? Younger firms are often growing faster, investing more heavily. Cutting out their early years removes some of that high investment activity.
Right, you're cutting out the saplings, like we said before.
Right.
Okay, what was the other screen?
They also dropped firm quarters associated with acquisitions bigger than 5% of the firm's assets.
5%. That sounds really low for an acquisition cutoff.
It is quite stringent. Buy it all point out that typical cutoffs, if used at all, are often much higher, maybe 15% on an annual basis. A 5% quarterly cutoff is very unusual.
And acquisitions are usually part of growth, right? So removing those.
Also tends to remove periods of higher investment and growth activity, especially since firms making acquisitions are often growth-oriented. Removing this M&A screen, as Buy It All called it, also increased the right skewness of the distribution.
So both screens seem to have selectively removed data points that would have pushed the distribution towards showing more investment, making it look more symmetric than it was.
That appears to be the effect, yes. And then there was one more thing related to how the data was presented.
Presented? You mean like in a chart?
Yeah. In their main figure showing the investment rate distribution, figure 1CP truncated the data. They cut off the picture at plus 20% investment on the right and negative 20% on the left.
So they just didn't show anything beyond those points.
Right. But Buy et al. Looked at CP's own data before truncation and found there's a significant chunk of observations, a whole tail, out beyond plus 20%.
Really? How high did those rates go?
The average investment rate in that truncated right tail was actually over 36%.
Whoa. So chopping that off visually would definitely make the distribution look less skewed to the right, wouldn't it?
Absolutely. It makes the distribution appear much more balanced or symmetric than the underlying data actually suggests.
Okay, let me recap. Buy et al. Find issues with. 1, using the wrong depreciation rates, which understated growth investment. 2, using non-standard filters, the age screen and the M&A screen, which likely removed high investment periods. And 3, truncating the visual representation, cutting off the high investment tail.
That's a good summary of the key methodological concerns they raised.
So the million-dollar question, what did the investment distribution look like after Buy et al. Made these corrections, when they fixed the depreciation, removed the screens, and didn't truncate?
Well, this is where it gets really interesting because the picture changed dramatically.
How so?
Instead of that relatively symmetric distribution CP reported, Buy et al. Found a distribution that was heavily asymmetric. It had a pronounced skew to the right and a fat right tail.
A fat right tail, meaning lots of instances of high positive investment, but relatively fewer instances of large negative investment.
Precisely. It looked much more like the kind of distribution Cooper and Haltiwanger found at the plant level years ago, the kind of distribution you'd expect if shrinking divesting capital is actually costly or difficult.
So the opposite of CP's conclusion, what were the actual numbers? You said the negative investment dropped.
Right. Depending on the specific combination of corrections, Buy et al. Found the skewness was much higher, somewhere between 3.5 and 4.8. Roughly. And that fraction of negative investment rates, it was consistently much lower, down in the range of about 4.9% to 6.2%.
So from over 18% down to maybe 5 or 6%. That's a massive difference.
It is. And it paints a picture that's completely consistent with costly reversibility being a significant factor for these large public firms, just like for smaller plans.
Which means CP's headline claim of no sign of irreversibility seems, well, pretty shaky now.
Based on Buy et al.'s reanalysis, yes. It looks like the original conclusion was largely driven by these methodological choices and errors.
It's quite something how these, seemingly technical details in data analysis can lead to completely opposite conclusions about how the economy works.
It really highlights the importance of transparency and replication in research.
Definitely. So what about the broader implications? CP had linked their findings to things like asset pricing models, right? The value premium.
They did. They suggested their finding of easy reversibility might mean value stocks, high book to market, weren't necessarily riskier in downturns because firms could just sell off assets easily.
But if Buy et al. Are right, and reversibility is costly,
then that whole line of reasoning needs rethinking. Buy et al. Argue that their corrected finding the asymmetry, the costly reversibility, actually fits much better with standard investment models.
How so?
Well, models that incorporate costly reversibility, often alongside something called operating leverage, can actually do a pretty good job of explaining why we see things like the value premium, and also why investment behaves the way it does. This idea of investment asymmetry being a key mechanism isn't new. It connects back to a lot of prior work in finance.
So Bayh-et-al's findings actually strengthen the case for those kinds of models.
It seems so. They argue that the evidence, once properly analyzed, points towards costly reversibility being important, which helps explain these long-standing patterns in asset prices and investment. They talk about the robustness of this mechanism it pops up as important in various theoretical frameworks.
Okay, so for you listening, the big takeaway seems pretty clear. That initial very strong claim that big public companies face no irreversibility, that they can shrink just as easily as they grow, looks like it was based on flawed analysis.
Right. The corrected evidence points the other way. It suggests that cutting back, selling off capital, is harder or less common than expanding, even for these large firms. Costly reversibility seems real.
And it just hammers home how vital careful data work and replication are in economics, doesn't it? What looked like a settled finding got overturned by digging into the details.
Absolutely. It's how science is supposed to work, ideally. Questioning, verifying, refining.
And understanding this asymmetry that growing is different from shrinking for firms has real implications for how we think about corporate strategy, market dynamics, the link between investment and stock prices, all sorts of things.
Which leads to a final thought maybe for you to mull over. If these big companies do face significant costs when they try to downsize, how does that influence their decisions before they get into trouble?
Yeah. Does it make them think twice about that big expansion? Does it affect how much risk they're willing to take on, how they might react differently to a recession versus a boom?
Exactly. How does that potential difficulty in reversing course shape their behavior day to day? It adds another layer to understanding business strategy in the real world.
Definitely something to consider. If you want to get into the nitty-gritty of the stats and the models, we absolutely encourage you to check out the Bayh-et-al paper and the original CP paper, too, for comparison.
For sure.
Thanks for joining us for this deep dive.